Hello and welcome. It's the economy. Today is earnings analysis time, especially of the banking and financial sector. Most of the results are in, except the big one, SBI. BOB is due today. But among the banks that have come, clearly there is a scar because of the fight for deposits. We have seen a reduction in deposit growth trailing advances growth, a fall in CASA and problems of credit being far ahead of deposits, and therefore a credit-deposit mismatch, something the Reserve Bank has been pointing out. There are also small problems of asset quality emerging. It's usually a first quarter phenomenon, but perhaps some of it could prevail, could continue. Let's ask the experts. Joining me now to discuss the banking results so far, Santanu Chakrabarti, the India Analyst, Banking and Finance at BNP Paribas, and Nitin Aggarwal, the Head of Banking and Finance Analysis, Institutional Equities at MOFSL, Motilal Oswal. Gentlemen, thank you very much indeed for your time. Santanu, I'll begin with the predictable one, ICICI and HDFC Bank. ICICI Bank, obviously, excellent results. But now, would you say price-wise, the advantage that it has shown in its results is kind of covered? Would you rate them equally, ICICI and HDFC Bank?
We have a higher upside and a higher preference for HDFC Bank, but we just put out a very detailed deep dive report on ICICI Bank a couple of weeks back, where we argued that it's time that now we start thinking of this as a 3 times price to book bank at the core level. Because what I tried to demonstrate out there, and something that we have been seeing in action, is currently ICICI Bank has what can be considered the greatest privilege in Indian banking, which is essentially adjusted for the size of the retail franchise and the overall operating cost and scale, the benefit of cheapest raw material. We tend to often think of raw material only in terms of cost of funds, but we have to load what yield is possible on the portfolio and, essentially what kind of operating costs are loaded onto it. And once you figure that out, you'll see that ICICI Bank has the privilege of not having to take any major risks, still maintain and gain market share, which is perhaps the biggest edge. So as far as upside goes, therefore, we have a small re-rating still due, nearly not as dramatic as what we perhaps have for HDFC. But in some sense, it is the most worry-free bank to own and less susceptible to quarterly volatility than any of the other names. Okay. So to that extent, it remains our second most.
Santanu, ICICI is trading at 2.86, and you're saying we should start looking at it as a 3 times to book stock. Yeah. One more question before I get to Nitin. What's your sense about when HDFC Bank will be able to get over its merger pain? Do you think it gets back to 3, say, in 2 years' time? What's the expectation from that stock?
HDFC's recovery trajectory has become highly dependent on what happens to overall system CASA. So in some sense, the monetary and liquidity conditions out there. So, if rate cuts are delayed, things like HDFC and Axis suffer a lot more than ICICI. If rate cuts happen early and there's a pickup in liquidity and monetary conditions, and therefore current account, savings account money within the system, coming off the low base that it is, its optimization of the entire liability side and therefore margins and ROA plays out earlier. So, we have very little doubt that, over a period of time, this normalization to about 2% ROA and 17% ROE at the core level will happen for HDFC Bank. But it's the timing is exquisitely dependent on the timing of rate cuts, how easily net durable liquidity goes into a surplus, and of course, at what point the gap between FD and SA rates reduced to the point that savings account money can start picking up again.
Okay. Fair point. I mean, those are all extremely extraneous factors when you're going to see liquidity adequate. Depends on how fast the government spends money. And as if we were all thinking that the Fed is going to cut and therefore there is a cut on the corner, BOJ has now raised. So we really don't know which way the Reserve Bank will go or how long it will take. Nitin Aggarwal, thank you very much for your patience. Let me come to the next 2 set of banks. We did ICICI and HDFC Bank. You can quickly tell me your position there, but more importantly, when it comes to Axis and Kotak, do you think that it's in Baizu?
Yeah, so see, both Axis and Kotak, there are one of the other things that is limiting their performance. If you look at Axis, this quarter, the business numbers were slightly modest, more modest, and wherein the deposit growth was like marginally negative. And that led to a slight rise in the CD ratio. And that's something wherein the bank is engaging with the RBI and has submitted a plan to improve things over the year. So that is an overhang on how the growth rate overall will be. And I think Street is factoring that in, and slight moderation in growth estimates have happened for Axis. So that resulted in the subdued reaction or some decline in the stock after the results. And Kotak, I will say, on the other hand, business numbers were relatively better, especially on the loan side, wherein the new management has delivered well. On the lending side, they have shown some bit of aggression and tried to compensate for the limitation that they have on the consumer side, especially after the RBI restrictions. So for the full year, we are still expecting loan growth to be higher for Kotak vis-a-vis Axis. And gradually, as you see some limitations going away, which is going to take time, but in the interim, bank anyway is making pretty healthy ROA. Our estimates are like well above 2, beyond 2. Like bank is already making close to 2.4 ROA. So if it sustains that level of profitability, which we expect by and large to be the case, then I think you can look at some moderate returns to come through from Kotak Bank.
Certainly
from
outstanding.
Motilal, we anyway have neutral rating on both the stocks.
Okay, what's your pecking order in the Nifty, in the banks, in the Nifty itself, Nitin?
We have been more positive on ICICI, SBI, HDFC Bank amongst the large names. And amongst the mid-size, we have been picking Federal Bank, which is outside Nifty, of course.
Okay, got it. Shantanu, to come back to you, what would your mid-cap bank preferences be? At least banks like AU Finance seem to have stood out.
Right, and that is our preferred mid-cap play.
Oh.
Now, having said that, Latha, I'm probably a little less constructive on the name that I used to be earlier. It's still, on a relative basis, amongst our mid-cap bank coverage, the best play. But I'm somewhat less than pleased about their margin defense and growth in core segments in the last 2 years.
Which
First quarter has shown on margin defense and as well as growth
AU Finance. You're speaking about AU Finance? Okay.
Right. That's been a little weak. I mean, typically people buy this bank because they essentially get almost an NBFC-esque franchise within those core segments with a low penetration argument to go in their geography. Right, that's one of the key reasons to own that bank, and that should have given it greater pricing power in an admittedly competitive environment. But perhaps the fact that the yields on either of those segments or their growth has kind of been a little lackluster in the last 2 years. I mean, sure, there's some improvement in the current quarter, has reduced my enthusiasm in the near term a little bit, especially given that it's not a cheap bank in that context, right? So, the performance standards remain a little higher than the typical mid-sized bank, which trades at 1.3, 1.4 times.
Okay, fair point. Nitin, to you, the public sector banks. I mean, Punjab National Bank stunned us yesterday when they said that they had guided for a credit cost of 100 bips, and now they're reducing it to 50 bips. I mean, that's dramatic. What in the PSU banks impresses you? Do you still think that they have this high provisioning base, which might give them an advantage on credit cost, on lowering credit cost and increasing profit?
Yeah, clearly, like PNB numbers were pretty strong across all the fronts. Even on the business growth side, like we did see a 5% sequential growth on advances from the bank. And specific to your question on the asset quality and provisioning, I think PSUs comparatively are doing a lot better. If you see, like all the banks, private banks have all come through with their results. And in general, we have seen either a status quo or a rise in credit cost across banks. And PSUs, on the other hand, is either a status quo or an improvement. And more likely it is an improvement rather than a status quo across banks. And which is where PSUs over the year are relatively better placed to deliver a stronger earnings for FY25. If I look at our estimates also, we have did some moderation across many private banks, and even the loan growth has seen a cut. While PSUs, because their credit cost is holding up very nicely, and in fact, it is moderating down. Like all the three banks which have come so far, Canara, Indian Bank, PNB, they've all reported a lower provisioning number than what we estimated. And if this trend goes through, and most of these banks are indicating a sustained trajectory on this front, while ECL provisioning is something that one will need to watch out as RBI comes up with the filing guidelines. But more or less, like these banks are well placed to deliver a high teens earning growth for FY25.
Okay. Yeah, I agree. Expected credit loss will take it out on PSU banks more. The private banks seem to be more prepared for it. But you still have only a neutral on PNB, Nitin. You were not impressed by the higher than expected, credit cost, or rather lower than expected credit cost guidance?
No, yes, we have, in terms of rating, yes, we have a neutral, but we raised target to 135 on the bank. We were at 130 earlier, which we raised after these results. Okay.
Shantanu, now to come to the NBFCs, even the mighty Bajaj Finance showed some trouble of bad loans. And, it trades at very expensive valuation. So will you take away something from it because of that, or do you think that it is seasonal?
Right. So in Bajaj Finance, what is quite interesting is now the narrative has moved along to margins and credit costs from 165 going to something like 185, 190 basis points. And of course, that means that even with 30% kind of loan growth for the full year, you end up with earnings growth, which is high teens, nearing 20%, if not touching it. And on that, we are making an argument, essentially, the street is, that a 24p for this is high. Now, if we put things in context, we'll realize that once rates start to come down, the margin mean reversion is nearly automatic. So the only meaningful thing to worry about from these results is essentially credit quality. Now, on credit quality, we need to drill down a little further. If we see, we'll see that the most challenges seem to be coming from B2C rural. And there, frankly, Latha, my sense is that Bajaj Finance doesn't have the kind of right to win within B2C rural, our research opinion, as it does within, say, B2C urban, which has been, the data-heavy specialization area of Bajaj Finance. And therefore, I mean, if I look at the history of Bajaj Finance has made the most number of experiments in terms of products. At points of time, it has done things like equipment financing. And everything that has not worked, they have been very nimble to kind of rationalize. And that's what makes it the powerhouse that it is today. Perhaps the B2C rural side of the business, large parts of it may not turn out to be a very successful experiment. But if you put in context what the rest of the business is growing at, it dwindles into a very small problem very soon. And again, the long-term earnings growth should track whatever long-term asset growth is going to be in this business. And in that context, the PE is about 30% lower than what the sustainable earnings growth probably is for the next 3 to 5 years.
Okay, so you're betting really on the corporate governance and the intelligence of the company to move out of what's not working. Very quickly, absolutely out of time, Nitin, but what are your mid-cap bets in the NBFC space?
So we continue to prefer vehicle financiers in NBFC space, wherein we believe that growth rates are going to sustain at a healthy level, asset quality performance is on track. And as the rate cut cycle comes through, these banks, these NBFCs will see some recovery in margins also. So which is where we like Chola, Shriram, PNB Housing. And so these are the three NBFC plays like we like.
Okay. Well, we do need a much longer segment to discuss the entire NBFC space as well. Gentlemen, thank you very much for whetting our appetite. We will touch base with you when the entire result season is over.